Welcome to Tech Money Madness, your daily U.S. stock market podcast. Today is Monday, August 24th, 2026.
And what a chaotic Monday it's been to kick off the week, honestly.
Seriously, it is just a fractured landscape out there today. For everyone listening, if you check the market briefing, you'd usually expect a pretty logical chain of events, right? A report drops, a stock moves, and we can all point to a simple cause.
Yeah, but not today. Today was a mess of contradictory signals.
Exactly. So our mission in this deep dive is to connect the dots for you. We're looking at massive macroeconomic tension, some incredibly aggressive geopolitical chess moves, and a day where U.S. equities just completely rolled over.
Right. I mean, the S&P 500 and the Nasdaq both closed lower, and the tech sector specifically came under intense pressure.
Which brings us to the central mystery we want to unpack for you. How does a regulatory decision in Washington about iPhone memory chips manage to completely crash AI hardware stocks, while at the exact same time triggering this massive, highly sophisticated options trade in gold?
It sounds wild when you put it like that, but they are absolutely connected.
But to get there, we really have to establish the gravity pulling everything down first. And that starts with the macro picture, specifically the bond market and the Federal Reserve.
Yeah, the Fed is casting a huge shadow right now. Investors are basically holding their breath ahead of Fed Chair Kevin Warsh's keynote at the Jackson Hole Symposium later this week.
They're paralyzed, right? Everyone is just desperately waiting for any signal on the interest rate path or some hint of a policy pivot.
Exactly, completely paralyzed. But what happened intraday tells a really fascinating story about market psychology. Treasury yields actually dropped for a brief window today.
Wait, they dropped. I thought everyone was worried about yields staying high.
They did, but it was driven by a CNBC report. The rumor is that Treasury Secretary Scott Bessent might use the general account to fund debt buybacks, and that was supposed to offer some fixed income relief.
Okay, let's unpack this for a second, because for anyone who doesn't work at the Treasury, the term general account sounds incredibly vague. What actually is that?
Sure, so think of the Treasury general account as simply the U.S. government's checking account. It's just where tax revenues sit before they're spent.
Okay, makes sense. So how does taking money from that checking account provide relief to the bond market?
Well, the rumor is Bessent might take that cash and use it to buy back older government bonds from the open market. When the government buys bonds, demand goes up, so bond prices go up.
And when prices go up, yields go down.
Exactly. It's essentially an artificial way to force yields lower and give the markets a little breathing room.
But, I mean, if you look at the prediction markets, traders are already anticipating that yields are going to climb right back up. So why would a temporary buyback fix anything?
It wouldn't structurally.
Right. Using the checking account to lower yields feels less like a real solution and more like, I don't know, running your air conditioner with the windows wide open. You get a brief breeze, but you're just draining the power grid while it's still 100 degrees outside.
That's a highly accurate way to frame it, actually. And prediction market traders are completely ignoring the buyback rumors for exactly that reason.
They're calling Washington's bluff.
Totally. They are looking at the structural heat. Right now, they're pricing in Treasury yields hitting new highs in 2026 and ending the year highly elevated. Because they know the Treasury can't just buy back bonds forever.
Are equity valuations just in a state of denial right now then, just playing a massive game of chicken with the Fed?
I think so, yeah. And the bridge between those high government bond yields and the tech sell-off we saw today comes down to a concept called real yields.
Which is the yield minus inflation, right?
Exactly. A real yield is the return you get on a risk-free government bond after subtracting expected inflation. And right now, real yields are approaching cycle highs.
So if I'm a big institutional investor, why would I risk my money on a volatile tech stock?
You wouldn't. Or at least your threshold for taking that gamble becomes vastly higher. The U.S. government is offering you a high, mathematically guaranteed return.
Just to hold a risk-free bond.
Right. Historically, when real yields spike like this, it acts like a vacuum. It just sucks capital out of risky equities and restrains economic growth.
That mathematical reality is just hanging over the market. But, the Fed's actions don't happen in a vacuum either. While everyone is obsessing over economic policy at home, Washington is aggressively weaponizing policy overseas.
Which brings us to the geopolitical risk premium, which is severely escalating right now.
Yeah, the Trump administration just unveiled this sweeping anti-Iran sanctions plan today. It targets the economic enablers of Iran, and they explicitly signaled that China is not exempt from this.
And the key detail here is that these are secondary sanctions, which is a massive escalation.
Let me stop you there because that distinction really matters for the tech sector. What makes it a secondary sanction?
So a primary sanction is the U.S. saying we will not trade with Iran. A secondary sanction is the U.S. saying we will not trade with anyone, anywhere in the world who trades with Iran.
Oh, wow. So you're forcing foreign banks and corporations to pick a side.
Exactly. You can do business with Iran or you can do business with the United States financial system,
Yeah.
but you absolutely cannot do both. By stating China isn't exempt, they are directly threatening Chinese entities.
And this tough on China posturing is happening right as the physical conflict risk is spiking. The U.S. and Iran just missed a 60-day ceasefire window today.
Right, which completely closes off the formal truce mechanism.
And Tehran is actively threatening ship seizures now. Plus, France and the UK are increasing missile aid to Ukraine after those deadly Russian drone strikes. The whole geopolitical map is just flashing red.
It really is.
Which brings us to this glaring paradox that I need you to explain. Because Washington is threatening economic war with China over Iran, right?
Yes.
But at the exact same time, the administration just surprisingly granted Apple regulatory permission to buy memory chips from two major Chinese suppliers, Shenzhen Memory Technologies, CXMT, and Yangtze Memory Technologies, YMTC.
It is a massive contradiction in policy.
How can we threaten secondary sanctions on China, but simultaneously let them power American iPhones?
It's likely driven by the sheer scale of consumer economics. They're trying to balance global leverage with keeping consumer goods affordable. But looking at the market mechanics, this Apple-China chip deal sent absolute shockwaves through the domestic semiconductor sector today.
I can imagine. If I'm an executive at a U.S. memory chip maker, I am terrified. How devastating is this for domestic companies?
It's basically an existential threat. You have to remember, memory chips are largely commoditized.
They aren't like the super specialized NVDA AI chips.
Right, exactly. Memory chips are a game of massive scale and ruthless cost efficiency. By letting Apple use CXMT and YMTC, the government just handed well-funded Chinese rivals the ultimate prize.
A guaranteed massive buyer.
A huge buyer. Once they secure Apple's volume, those Chinese manufacturers get the economy of scale they need to drive their production costs into the floor. It makes it practically impossible for U.S. chip makers like Micron and SanDisk to compete on price.
Well, that perfectly explains the absolute carnage we saw in the sector today. I mean, the SOXL ETF dropped 8%, Micron fell roughly 5%.
And SanDisk plunged 7.5%.
AMD traded in the red, and NVIDIA declined 2%. It was just a bloodbath. But the story with AI hardware is getting even more complicated than just memory chips, isn't it?
It is, yeah. NVIDIA confirmed today that their new Grok chip racks will be online this year. That follows a $20 billion purchase entirely aimed at low-latency AI inference.
And inference is the key word there, right? That's the next phase of the AI trade.
Precisely. For the past 2 years, all the massive spending was on AI training, building the brains of the models. Inference is the daily application. It's when you actually ask the AI a question and it answers you.
So NVIDIA is signaling they want to ruthlessly dominate the actual deployment of AI, not just the construction.
Right, and that puts incredible pressure on the smaller players trying to carve out a niche.
Like Cerebras Systems, for example. Their stock crashed roughly 14% in extended trading today. And the kicker here is they actually reported strong second quarter revenue.
Yeah, that caught a lot of people off guard.
How does a company beat earnings and instantly lose 14% of its value? Is the AI honeymoon officially over?
I wouldn't say the honeymoon is over, but the market is definitely waking up to the operational reality. The expectations baked into these AI valuations right now are priced for absolute impossible perfection.
So merely great results just aren't enough anymore.
Exactly. The market has priced in a flawless exponential growth curve. When Cerebras shows good but not world-altering results, the valuation just collapses under its own weight.
And we're seeing pushback on the broader AI narrative culturally, too. A Goldman Sachs partner actually issued a warning today that an over-reliance on AI could weaken the reasoning skills of future bankers.
It's a classic vibe shift. The market is transitioning from blind optimism to demanding structural proof of value.
Speaking of demanding proof, let's look at the Broadcom and Marvell situation today. Broadcom fell about 5%, while Marvell jumped roughly 8%.
And that was entirely because Marvell announced an expanded custom chip agreement with Google.
Right. To me, that seems like a straightforward win for Marvell and a permanent loss for Broadcom. Why wouldn't Broadcom sell off?
The market certainly treated it as a permanent loss, but this is where historical context is really vital. Back in 2023, Apple famously designed away from Broadcom components.
Oh, I remember that. Everyone panicked.
They panicked. They assumed Broadcom was severely damaged. But following that loss, Broadcom's revenue nearly doubled, and its stock gained over 500% because the underlying demand for AI networking infrastructure was just so massive.
Wow, okay.
So the market today might be severely overreacting to Marvell's win and completely ignoring Broadcom's deeper structural advantages across the rest of the data center.
So tech hardware is facing these impossible valuation standards, bond yields are acting like a gravitational pull, and Washington is greenlighting foreign competitors. Let's do a quick rundown of the market movers, because corporations are reacting to this in wildly different ways.
It's a massive bifurcation right now.
Let's run through it. We saw SOXL down 8%, SanDisk down 7.5%, Micron down roughly 5%, Broadcom down roughly 5%, Cerebra's down roughly 14%, and then Marvell was up roughly 8%. But the big international mover was Alibaba, down 10% today.
Yeah, and that 10% plunge for Alibaba was strictly because they priced a $10.2 billion share placement just to fund their AI investments.
They are essentially raising capital at a huge penalty just to stay in the race.
Exactly. They have to adapt. Apple's doing the same thing in China. They're training their own large language model now and reducing their reliance on Alibaba entirely to ensure digital sovereignty.
But then you have companies that are just paralyzed by regulations. Look at the media M&A freeze. The Paramount and Warner Bros. Discovery merger is basically dead in the water.
Right, because California AG Rob Bonta canceled a settlement meeting, citing Paramount's lack of good faith. That antitrust battle is chilling the whole broader industry.
Meta analysts are maintaining a hold rating purely because of litigation overhang. UPS is trying to pivot, committing $2 billion to global growth.
While United Airlines is literally stuck in limbo, waiting on certification delays for their Boeing 737 MAX 10 premium lie-flat seats.
It's crazy. Oh, and Trump Media's interim CEO is successfully monetizing faster access to Truth Social posts now.
Creating premium fast lanes, yeah. It highlights how uneven the regulatory application is. Because while media is frozen, regulators are actually opening the doors for banks.
Right. Wells Fargo and Citigroup now have the capacity to acquire large regional banks, and they've already identified 5 targets.
Mega banks get a green light for consolidation, but media networks are blocked from merging. It's wildly inconsistent.
With all this corporate gridlock and equity volatility, the rotation into alternative assets today makes perfect sense. Crypto just extended its rally, logging its biggest 3-day move since 2023 on Bitcoin's breakout.
And the options activity in gold was absolutely massive today.
Yeah, let's talk about the GLD ETF. Nearly 116,420 strike calls expiring September 18th were sold just 20 minutes after the market opened.
Which is an incredible volume.
Can you break that down for us? What does selling a 420 strike call mean, and why is doing it 20 minutes into the day a big deal?
Sure, so think of a call option like an insurance policy or a lottery ticket. It pays out if the price of gold shoots past a certain level, in this case 420. By selling 116,000 of these tickets, an institution is essentially acting as the casino.
They're collecting the premium up front.
Right. A massive amount of cash from buyers who are betting gold goes to the moon. And executing this huge block just 20 minutes into the trading day is a structural whale-sized maneuver.
So they don't think gold is going to spike past 420 by September.
Exactly. They think it'll be volatile, but it won't breach that ceiling. And more importantly, they're probably using that massive influx of premium cash to fund a complex hedge elsewhere.
So if you synthesize everything we've talked about today, what are the key takeaways for you?
There are 5 key themes we are tracking. First, Iran sanctions and geopolitical risk are feeding serious risk-off sentiment. Second, the semiconductor sector is undergoing a massive stress test from Chinese competition and valuation concerns.
Third being the bond yields and the tension heading into Jackson Hole.
Right. Fourth is that media M&A frees from the Paramount WBD antitrust battle, which could chill the broader industry. And fifth, crypto extending its rally and that highly unusual gold options activity in GLD.
It really is an incredible web of cause and effect. It shows that institutional capital is actively fleeing into alternative assets to escape this gridlock.
Absolutely. The smart money is hedging heavily against traditional equities right now.
So as we look forward to tomorrow, understanding how these forces push and pull against each other is the ultimate shortcut for you to navigate this landscape.
And, I'll leave you with one final provocative thought to mull over regarding all this.
Go for it.
If U.S. tech giants are increasingly relying on geopolitical rivals for their physical hardware, while simultaneously pivoting to self-trained, localized AI models to completely bypass those regional partners in software, are we heading toward a future where the global tech ecosystem is entirely splintered?
Like into highly guarded regional digital fortresses.
Exactly. It completely changes how we have to value these companies moving forward.
That is a staggering thought to end on, especially since modern tech was built on borderless integration. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.